How do the Fed, interest rates, and the price of money affect our lives every single day? In our very complicated society, there aren't too many things that are a lot more complicated than interest rates. I'm not talking about being more complicated than science and molecules and all the other complicated things that doctors and these highly educated people deal with, but interest rates affect our businesses, our personal lives in ways that are enormous. And it's important to take just a couple of minutes because if you want the inside track and you want to be able to really profit from the inside insights that I can share with you on some of these topics, hang on and let's just take a look at this. First of all, understand that the Fed, which controls all the banking functions, they control the central bank in the United States, is not part of the government. The Fed is a private company that was established in the beginning of the last century to control all of these regular banks. It's not well understood by outsiders, but the Fed itself was organized to protect interest rates, to protect the economy, and to create sort of an international body. I'm not sure it exactly worked out the way it was planned, but that's what we have. It's not a political body, and the United States government doesn't have nearly as much control of it as it would like, although the current president is trying to exercise more control over the Fed than has been exercised in the past, or at least in the recent past. In fact, he recently made an appointment to the board of governors of the Fed, and we'll see how that guy does. But here's the deal. Interest rates affect everything in our society. It affects all pricing of money, and the price of money affects all price of all goods and services. So the Fed has a sense about where they would like the economy to be. They have a sense about how they'd like pricing to be. They have a sense about where they'd like the stock market to be. Personally, those seem like decisions that should be made by politicians that are then carried out by the Fed. But the Fed actually has a lot of autonomy, and they decide these things themselves. So when they change interest rates, the stock market immediately jumps. And here's the way that works. When interest rates are a little higher, investors have more safety by putting their money into cash. So they pull money out of the stock market and they put it into the interest-bearing accounts of some kind. So the stock market goes down. So when interest rates go up, stock market always goes down. Conversely, when interest rates go down, it becomes less attractive to put money into interest-bearing accounts, so people push their money into the stock market. It's very well known. It absolutely always works this way, and that's the way that it happens. So the Fed has a lot of control over how much the stock market goes up or down. The current president would like to see the stock market stay stable or continue to rise, and therefore would like the interest rates to stay low. In fact, he's asked for a half-point decrease in the amount of the interest rate that the Fed charges banks on a day-to-day basis. That's called the federal funds rate. It affects us all in a very significant way because the cost of borrowing for all of us is affected. Now, it doesn't affect all kinds of borrowing because there's really two different kinds of interest rates. And this isn't designed to be a complicated economics course. But if you want the inside track, you have to understand a couple of things. There are short-term interest rates, which are generally interest rates that are 1, 3, 5, 7, even up to 10 years. And then there's the long rates. The long rates go to 30 years. Those are mortgage rates. So businesses that borrow for their working capital just to keep going, to kind of bridge their cash flow, those rates tend to be the short rates, the shorter term rates. And those rates can be anywhere from the prime rate plus a couple points all the way to something a lot higher. Longer term rates, which are very desirable to get a long-term interest rate, tend to be a little bit lower because you have a guarantee of some money over a long term, or at least the way these pools are organized, the money is set to yield good cash flow for a long time. So all of these things affect us. So when the Fed makes a move, it affects our businesses, it affects our personal life, it affects the cost of our mortgages. And for people that have those variable mortgages, it can affect them a lot. And there are different kinds of interest rates that are all published and so forth, but they're always derivative of the federal funds rate, which is the rate that the Fed charges the banks on an overnight basis because they have to keep a certain amount of reserves. And if the reserves aren't in order, then they have all sorts of problems. So they have to borrow sometimes to keep their reserves in order. So anyway, listen, the bottom line with interest rates is that the Fed and the Federal Reserve and interest rates have a lot to do with everything that happens to you in your personal life, in your business life. And you need to pay a little bit of attention to that. And that's the way you get the inside track. And that's the way you can profit from the inside and the insights that we bring to the table for you. I hope that you're good. In the meantime, go out and profit from the inside.